This is Financial Standard, the definitive source of news, thought leadership and analysis for Australian wealth management professionals. Financial Standard. Take the lead.
Hello and welcome. I'm Chloe Walker with Financial Standard. Following the bond market bloodbath and an unflattering performance in 2022, fixed income had somewhat of a renaissance in 2023 as investors searched for certainty amid volatility. But will this persist in 2024? Today, to explain the current landscape and give his opinion on what's in store for the next 12 months, I am joined by UBS Managing Director and Head of Australian Fixed Income, Tim Van Claveren. Tim, thank you for joining us.
Yeah, hi, Chloe, and really appreciate being invited to come along to discuss the markets with you.
Yeah, great to have you. So, Tim, looking back, how did fixed income perform in 2023, considering that last year was a real challenge for the asset class?
Yeah, a very interesting question and a great place, I think, to start this discussion. I think for most of the viewers, they would fully remember what happened in 2022, as you say. At its worst point, the Australian Composite Bond Fund, which is the benchmark index that most managers manage to, at its worst point, it lost 11.5%. This is for a fairly defensive asset class. So I think that was a bit of a shock to a lot of investors and probably twice as bad as the previous worst year back in 1994.
Yeah.
So when you put things in a historical context, it was a bad year. I think, what's happened so far for 2023, I think for a lot of investors, I think this year probably has been disappointing in terms of returns. I think people definitely said this year would be better than last.
Yeah.
But I think the returns that they would have expected would have been higher than where we are at the moment. But I will say the year isn't ended. So as of October, the AusBond Composite Index had delivered a negative 1.18% return for the 1 year number. So again, another negative rather than a positive number than people would have been expecting. But in November, yields have fallen and continue to fall. So this monthly number is looking a lot more positive and highly likely that return then will turn positive, and we'll see what December brings. So hopefully by the time we get to Christmas and New Year's Eve, that the yearly number looks a lot better than it does at the end of October.
Yes, fingers crossed. And it's interesting that you mentioned sort of that underwhelming performance for the fixed income market this year. What factors impacted that narrative? And then I guess now that it's looking a bit more positive, what do you think is behind the performance changing from negative or underwhelming to positive?
It's been an interesting year and a very volatile year.
Yes.
So the outlook for bonds, I think that most people had definitely played out in Q1. Yields fell quite aggressively, and that was on the back of all the troubles in the US regional bank sector that people would be fully aware of.
Mm-hmm.
But then once we got through that scenario and global economies looked a lot more robust and inflation remained a bit more stickier, yields from that point started to rise again, back to the previous highs, back towards, say, August this year. What then, I think, surprised the market was that through September and in October, yields rose about another 100 basis points from their previous highs or close to it. And that was very much driven, as you ask, around very much from more the US. The Fed started to talk a lot more hawkish. I think markets started to become a bit more concerned that there were further rate hikes to come, whereas previously they thought we were at or close to the peak. And then a lot of that was driven by US fiscal policy where the US government, even though the Fed's tightening, the US government is still spending a lot of money. And that means they have to issue a lot of bonds as well. So I think that spooked the market and that drove bond yields higher.
Yeah, that makes sense.
Yeah, and yields touched 5%. So I think that spooked a lot of investors.
Yeah. Definitely. So there's a bit of debate on whether a global recession will hit. If it does, Tim, how do you expect it will impact the asset class and how will it be reflected in the pricing of the fixed income market?
Yeah, another very good question. we're not necessarily focused. I think a lot of people at the start of the year were probably forecasting, especially the US, would be in recession by the second half of this year or early next at the latest. But I think from an economic perspective, what has surprised the market has been that growth has held up a lot more firmer than what people had expected. And on the corporate side, corporates are still, been able to retain a lot of their margins, as in pass their costs through to consumers, and stay still fairly profitable. So, it's kind of growth has been kind of more surprising up to now. So looking into next year, our base case is not for a hard recession. Definitely growth will be softer. Maybe we get a mild recession, but we're not forecasting anything too dramatic, especially if the Fed keeps its rate policy here where it is at the moment. If rates go up further from this point, that then changes, but we don't think that is likely to occur. In Australia, it's been a bit of a different story, an interesting story. So we were never forecasting a recession here, and we're not forecasting one for next year. And the key factors there are around net migration in our external account. And I think that's been a surprise locally that if you look at what's happening here from an economic perspective, if you look from a nominal perspective or per capita, you get a vastly different story. So from a nominal perspective, things still look pretty robust. They are slowing, but the numbers are still pretty good. But a lot of that's been driven by net migration. So it's the 600,000 new migrants that have come into the country that have kept demand very strong. If, though, you look at on a per capita, things, you get a totally different picture. So next year, again, because of this element of net migration, we think that nominal growth and spending will, be below trend, but still hold up. But on a per capita basis, or even when you measure, say, consumption on a real basis, I think those statistics will start to show you that there is we could already be in a recession on those metrics. I think if you're a local homeowner with a mortgage and a consumer, I think you'll be very much feeling the pinch next year, and it will feel like a recession, even though as I said, the nominal numbers may not show that.
Yeah, yep. I mean, on the brighter side, there is speculation that fixed income might outperform equities given the diverse spectrum of investment options available, including, term deposits, government bonds, corporate bonds, capital notes, and income securities, which might withstand market challenges. What's your opinion on that? And what is the projected risk profile in comparison for both fixed income and equities?
Yeah, no, another very good question. I think if you going back to one of your earlier questions around this year, so any fixed income fund with duration or long duration up until end of October was probably printing annual returns negative or slightly positive. But the sweet spot to be has been short-dated credit. So if you're in short-dated credit funds, then the returns have been far more attractive. So, you could be talking a 6 or 7% return rather than a minus 1% return.
Why is that?
Because credit has performed very strongly this year because the macro backdrop's been quite positive. Corporates are still being able to pass through any margin pressure onto consumers, and consumers have been willing to pay the cost increases.
Yeah.
Corporate fundamentals, even though they've been weakening, they've weakened at a slower pace than I think most people would have thought. And that's why equities for this year have also performed, in a relative sense, a lot better than what people probably would have thought. I think looking into next year, though, it could be a different story, because if you're expecting weaker growth and inflation will continue to come down, then, the possibility of central banks cutting rates come into play. And I think in the US, you would pencil in maybe Q3, Q4, you may start to see some rate cuts over there. For the RBA, it'll be interesting to see again if we see rate cuts here, but usually historically you see a rate cut about 9 months after the last hike. So as we saw the last hike in November on Melbourne Cup Day, If you didn't win at the races, you definitely lost on your mortgage. Speculation, maybe they go again in February. We don't think that's the case. But if the market starts to think that the RBA will put in cuts sometime next year, and then normally what you find is that bond yields should start to rally. So the way the economic cycle plays out, as you get into softer growth and the risk of recession, markets will start to price in rate cuts, and therefore longer bonds. Yields should fall and prices should go up. So, yeah, our expectations would be that next year, the outlook for fixed income funds with duration in them should be a good place to park your money. Now, compared to other products like term deposits or income securities, you don't benefit. You may lock in a yield for a particular point in time, but you don't benefit from yields falling. And the way the maths work, if you have a bond with a 6-year duration, if yields fall 1%, you'll get the running yield plus the 6% capital profit. So the running yield is, say, called 4.5% plus 6, you'll get 10.5% return. Now, locking your money into a term deposit for 6 months at 5% may look attractive, but that's less attractive than if you put your money into a bond fund.
Yeah, right. Oh, thank you for explaining that. And do you have any other predictions for how fixed income will perform next year or even into 2025?
Look, I think it's going to be like this year. It's going to be a volatile market. So it won't be one-way direction. So I think investors have to pretty much put your money in for the long game.
You said that, yeah.
Yeah. And the big thing driving markets, I think, is that the fact that most central banks, if not all, are at the peak of the rate hiking cycle. And that's usually the best time to put your money into fixed income. So, we think that it's a great place to be. The other benefits of fixed income, I think, for a lot of investors to consider, and this wasn't the case 2 years ago when yields were at historical lows, as you can remember. 3-year bonds were at 10 basis points. The income, the yield, the capital protection wasn't very positive, whereas where we see yields at the moment, you're at decade highs. And what does fixed income deliver? It delivers the steady income stream that investors need. If you hold the bonds to maturity, it gives you capital protection. But also if you hold a multi-sector portfolio, so you have other growth assets in your portfolio like equities and other risky assets, fixed income works as a diversifier. This didn't occur in 2022, but we think those historical characteristics are back for the asset class. And I think the big thing for Australia, that as we move out of that accumulation phase, where you invest a lot of your money more in growth assets like equities and property, as you move more into that retirement phase, what should be important to people is capital stability and income. And fixed income is that one of those asset classes that can deliver that for investors.
Yeah, you're absolutely right, Tim. Well, thank you so much for taking the time to share your insights. I've certainly learned a lot, and it was great to have you on the show. Thank you. I
appreciate the invite to talk, and we'll catch up soon. Thank you.
Yes, sounds great. Go bonds.
Yes.
Cheers.
Thanks for listening to this Financial Standard podcast. For more information, visit financialstandard.com.au. Please keep in mind that the information discussed in this podcast is general in nature and does not consider personal circumstances. Reliance should not be placed on any content without further independent financial research and advice.